in this section, we're going to be looking at Forex terminologies. We're going to be learning about terminologies in the Forex market or in the Forex industry. Okay. And these are important terminologies that professionals use on a daily basis. And this will help you understand how the whole market works or how the whole Forex business works. And it's very important for you to know them. Okay. So there are a lot of terminologies in Forex, but there are some very important ones. We might not go through all in this video or in this section, but of course, as we go through the course, you're going to learn them. Okay, so we're going to be treating price terminologies in this video, and in the subsequent videos, we're going to be treating other terminologies. So for price terminologies are terminologies that have to do with the price. Okay, that's the price of a currency or price of a currency pair. So in this video, we're going to be looking at spot price, ask price, and bid price, and then spread. We're going to be learning all about this. We're going to be learning what the spot price is, the ask price, the bid price, and the spread are. So for the spot price, the spot price is the current exchange rate at which a currency pair can be bought or sold in the Forex market. It is basically the quote price for any given currency pair. Okay, it's basically the quote price for any given currency pair. Remember, we spoke about the base currency and the quote currency. So the spot price is the direct price of the quote of currency, or rather the quote price for any given currency pair. Okay, so that's the price you see of an asset or of a currency pair when you want to buy or sell it. So for example, let me just open TradingView here. We're going to be learning more about TradingView in subsequent videos, but I just want you to have an example. So when you open a platform like TradingView or a trading platform, there is this line you see. Now you can see this red line. Okay, now you can see this is GBP USD I'm looking at here, and the price is 1.20673. so this is the direct price one can buy or sell GBP USD at this moment. Okay, so this is the spot price. So this is the spot price for GBP USD at this moment. This is the weekend, and that's why you can see the charts moving. But if this was a weekday, of course, you're going to be seeing the charts or the prices moving constantly. That's because the prices are never constant in the market. Okay, so just for you to understand, this price 1.20673 in this case is an example of what a spot price is. Okay, so what of the ask price? The ask price is the price at which a forex trader buys a currency pair. So when you are buying a currency pair, you're actually buying at the ask price. Okay, and then the bid price is the price at which a forex trader sells a currency pair. So there are two prices. We have the ask price and we have the bid price. When you are buying a currency pair, you are buying at the ask price. When you are selling the currency pair, you are selling at the bid price. Okay, and then that's what we call the spread, and the spread is the difference between the ask price and the bid price. Yeah, so the spread is what your broker charges you when you buy or sell a currency pair. So if you initiate a sell trade with your broker is going to sell the currency pair for you at the bid price, and if you initiate a buy trade, your broker will buy the currency at the ask price. And then the difference between these two prices is the spread, which is the profit which the broker makes. Okay, so let's just come to this chart here, and okay, I've enabled the ask price. Now if you see well, you're going to see two lines here. You're going to see two lines here. These are price lines. Remember, we're going to look at trading terminals or trading platforms in our subsequent videos, but I just want to show you this. So this is GBP USD. Okay, I'm looking at GBP USD here. This is a trading this is MT4, a trading platform. Okay, so this is 1.20780. okay, and then this is 1.20659. so as you can see, there's a difference between these two prices. So this one on top is the ask price and this one is the bid price. So That's just an example of the ask price and the bid price. When you open a platform like this, you normally do not see the ask price, but you have to come and enable the ask price to be able to actually see it. So as you can see, from this price, that's from the red line to this line, we have a difference of, I think, about 10 or 11 pips. 10 or 11 pips. So if you subtract this one from this, you're going to see that we have 10 or 11 pips. Okay, so let's just try to use our calculator. Okay, let's use our calculator to just do this simple calculation. So let's see, let's say 780 minus 659 minus 659. So you can see we have a 12 pip of difference. Remember, we spoke about pips in our subsequent lectures. So we have a 12 pip difference in price between the ask price and the bid price at this moment. So if you are going to be buying this market, if you're going to be trading this currency pair now, of course it's not possible because it's the weekend. So but if you're going to be trading this, the broker is going to be charging you 12 pips. Okay, 12 pips just to place a trade. Okay, just to place a trade. So the spreads are very high at this moment because this is the weekend. So the spreads are usually very high, but they are usually not this high on normal days. Okay, so if you are buying this market, for example, the broker won't buy it from here, he's going to buy it from here. Okay, the ask price, he's going to buy it from the ask price. So you're going to start at a negative number. So you're going to start at minus 12 pips. And then if you're going to sell this market, the broker won't sell it here, he's going to sell it, won't sell it here, he's going to sell it here. Okay, he's going to sell it here. So you're going to start at minus negative, or rather minus 12 pips. Okay, so that's what the broker is charging you for placing a buy trade and sell trade in this case. So that's it for the price terminologies. That's the spot price, the ask price, the bid price, and the spread. In our next video, we're going to be looking at even more terminologies. Hope to see you there. Bye. Hello everyone and welcome back. In this video, we're going to be learning about lot size, okay, or lots. So we're going to be learning what lots means in Forex or in Forex trading. So a lot is the amount of currency bought or sold in a single trade. It's the standard measure of the units of currency a trader buys or sells. Okay, so as traders, we use what we call lot sizes. You might have heard a trader say, okay, I used this lot size, I used one lot size, I used 1 point something lot size, I used this lot size and that lot size. So that's that terminology, lots, is actually the measure of how much of the currency pair that trader buys or sells. Okay, so we have what we call a standard lot, which is 1.0. So a standard lot is basically 100,000 units of the base currency. So if you are trading a standard lot, it means you are buying or selling 100,000 units of the base currency. And remember, I told you the base currency is the first currency listed. Okay, that's for example, here we have GBP USD. So the base currency is GBP and the quote currency is USD. So a standard lot will be buying 100,000 units of GBP. Okay, so that's what is known as a standard lot. So when you're entering a trade with a standard lot or with a standard lot size, you're going to be buying 100,000 units of the base currency. That's GBP in this case. So some of you might be asking, or might be surprised, or might be saying, okay, 100,000 units, that's so much. You might not have that much money to enter that trade, to facilitate that trade. But that's not for you to worry about, because like I said before, or like I told you in passing in one of the previous videos, in Forex trading, we use what we call leverage. So leverage is basically the broker lending you his money to help you facilitate your trades. Okay, so when you use leverage, you'll be able to buy as much as 100,000 units, okay, which is a standard lot. So that's what leverage does. That's it for a standard lot. And then next we have a mini lot, which is 10,000 units of the base currency. So a mini lot is 0.1. And then we have what we call micro lots, which is 0.01, which is 1,000 units of the base currency. So we have an example here. So if the Euro USD exchange rate as at this time is 1.30000, and then so it means one standard lot of the base currency, which is euro, would be 100,000 times 1.3. Okay, that's 130,000 units. So this means that at this current price, you will need 130,000 units of the quote currency, okay, which is USD, to buy 100,000 units of the base currency. Okay, that's when you're using standard lots in this case. So that's basically for the concept of lots or lot sizes. We're going to be working with lot sizing, or lot sizes rather, in our subsequent videos where we'll be entering trades. Remember, we're going to be entering live trades in this course. We're going to be entering live trades, so we're going to be using lot sizes a lot, because every trade you enter must have a lot size. Every trade you enter must have a lot size. Your lot size basically determines how much your risk exposure is to the market, okay? And so it means we're going to be working a lot with lot sizes. So that will be it for this video, and see you in the next. So in this video, we'll be learning about pips, okay? So the full meaning of pip is percentage in price, or price interest point. So either of these is the full meaning of pip. And a pip is the smallest whole unit price move that the currency pair can make. It's the smallest change in price by 4 decimal places. So if the price moves from 0.0001 to 0.0002, it means the price has moved 1 pip. If it moves 0.0001 to 0.0003, it means it has moved 2 pips. Okay, and then we have what we call the pipettes, or the points. Now this is the smallest change in price by 5 decimal places, by 0.00001. So if the price moves from 0.0001 to 0.00002, it means the price has moved 1 pipette, or 1 point. Now there are 10 pipettes, or 10 points in 1 pip. Okay, there are 10 pipettes in 1 pip. So that's the basic idea of pip and pipette. Most of our lecture, or most of our studies in this course, or calculations or analysis, will be in pip. Okay, will be in pip, and pipette is a little bit too minute, too little to look at, so most of our work will be done with pips. Okay, we'll be doing most of our calculations in pips. How many pips this, how many pips that. So you can hear a trader say they made 40 pips, 50 pips, they made 10 pips. The spread is 5 pips. So it's basically the unit of movement of price. So when price moves by 4 decimal places, it means it has moved a pip. So we're just going to come to trading view once more. Come to trading view, and then now you can see that the current price for GBP USD is 1.20673. We can testify that this is 5 decimal places. So it's been analyzed down to the last point, okay, or down to the last pipette. Okay, so we can see 3 pipette here. So when the price moves from 1.20673 to 1.20683, it means the price has moved 1 pip. If it moves from 7 to 9, it means it has moved 2 pips. Okay, so that's basically the idea of pips and pipettes. So when we enter trades as traders, we often want to make as much pips as we can. Okay, because the more pips you make, the more profits you make. The more pips you make, the more profits you make. Okay, so that's the basic idea of pips, and the next video we'll be learning about more terminologies. See you there. So in our previous lectures from this section, we've spoken about Forex terminologies. we learned about terminologies like the lot size, learned about pips, we learned about the ask price, the bid price, and the spot price. So in this video, we're going to be learning about another terminology, which is known as the pip value. Okay, so we're going to learn how to calculate the pip value and how to calculate the profit we make from our trades. Okay, so what's the term pip value? What does it stand for? So the pip value is what enables a trader to ascertain the amount of money they make or they lose for each pip movement if a trade goes in their favor or against them respectively. So the pip value depends on the lots used. Okay, remember we have spoken about lots or lot size, and this pip value we are talking about now depends solely on the lot size the trader uses. Okay, so the pip value is always in the quote currency. It's always in the quote currency, and there's a formula for calculating the pip value, which is lots times 10. Yeah, so it's lots times 10. We're going to look at an example later on, and we're going to learn how to calculate the pip value. Okay, we're going to learn how to calculate the pip value and how to calculate the profit we make from a trade, even if it moves more than one pip. Remember, the pip value is the value of one pip movement. So what if the price moves more than one pip? We're also going to be learning how to calculate the value. Okay, so the actual profit made depends on the lots used and the pips gained. So there's a formula also for actual profit, which is the pip value times the pips gained. Okay, so that's these are things you should have in mind before we move to the next slide. I'm just gonna move to the next slide. Now the next slide is an example. This is an example using Euro USD. Okay, so we are assuming that the current price for Euro USD is 1.30000, and then the price moves from 1.30000 to 1.30010, which means it moves one pip. Okay, so there's a one pip movement in Euro USD, and we trade one lot. So our trade is one lot. Now the contract value for one lot will be equals to 100,000 of the base currency, which is euro in this example. Remember, it's Euro USD, and lot is a standard lot is 100,000 of the base currency. So it's going to be 100,000 of euro. Okay, so now the contract value will be 100,000 multiplied by the price, the current price. Now that will be 130,000 USD. So we're going to need 130,000 USD to be able to fund this contract. Okay, so if the price moves to 1.30010, which is a one pip movement, then the contract value will be 100,000 times 1.30010. Okay, so for the one pip movement, we now have to find the contract sum for that one pip movement. We have to now multiply 100,000 euros by the new price. Okay, the new price after the one pip movement, which is 1.30010. Now that's equal to $130,010. Now the pip value for the price move will be $130,010 minus $130,000, which is equal to $10. So the pip value for this price move is $10. I remember I said the pip value from the previous slide, that the pip value is always in the quote currency. Now the quote currency for Euro USD is USD. So the pip value is, in this case, is $10. So for one pip movement, the value is $10. Okay, so let's go to this last point, which is now that the actual profit made from the total move will be pip value times pips gained. Yeah, and the pips value is lots times 10 times the pips gained. Now this is the pip value, which is 10, and of course it's one pip movement, so it's $10. Now what if we made more than one pip? What if we made let's say 35 pips. So if we make 35 pips, the value for the movement of 35 pips will be equal to 10 multiplied by 35. So it means we'll have made $350. We'll have made $350 for a 35 pip movement of a Euro USD trade placed with one standard lot. So that's as simple as that. Now you understand what we mean by pip value. You can calculate the value of a pip. You can calculate the value or the actual profit you've made for whatever amount of profits or of pips rather, of pips movement your trade makes. So in the next video, we'll be learning about more terminology. We'll be learning about the leverage terminology. Okay? So hope to see you in the next. So we had spoken about leverage in our previous videos in passing, and in this video we're going to be looking at leverage in details. Now the Forex market is the most leveraged market. In fact, some people call it the leveraged market, and that's because it gives the highest amount of leverage among all other financial markets. So it gives traders the highest amount of leverage. Now, what is leverage? Okay, so leverage in Forex allows traders to increase their market exposure beyond their initial investment or deposit. And this is made possible because the broker loans you their money to be able to enter a position that big. Okay, now why is there leverage in Forex? Leverage exists in Forex because the movement between prices of currencies are usually very minute, very little. So in order for us to make any substantial profits, we have to take advantage of those little movements, and leverage is the only way we can take advantage of those little movements. So leverage enables us buy or sell more than we actually can afford, okay, so as to be able to make substantial profits. So with leverage, a trader can actually enter a position worth 10 times or 100 times or even 1,000 times more than their actual money can afford, and no other financial market gives that level of leverage. However, it is essential to know that when using leverage, not only profits are magnified, but also losses can get magnified. So it's important not to use leverage too much. So it's important not to use too much leverage. Some brokers can give you 1,000 times your money, can give you 10,000 times your money. I haven't seen a broker giving 10,000 times your money, but in Forex, anything can happen. I'm sure there are brokers who will be willing to loan you up to 10,000 times your money, but that doesn't mean you should use that much leverage, because leverage can actually build you up and also kill you. Okay? It can build you up or kill you. So leverage of 10 to 1 means that traders can gain exposure to a notional value or trade size 10 times more than the deposit that is required to fund the trade. So when your broker gives you a leverage of 10 to 1, it means you can enter a trade 10 times your deposit. If your broker gives you 100 to 1, you can enter a trade 100 times your deposit. If your broker gives you 1,000 to 1, it means you can enter a trade 1,000 times your deposit. I don't know if you understand. If your broker gives you 1 to 1, of which doesn't exist in Forex, but if let's say your broker gives you 1 to 1, it means your broker doesn't give you any leverage. It means your broker doesn't give you any leverage, and if you're entering a trade, you'll be totally responsible for funding that trade. It means if you're entering a trade with one lot size, it means you have to fund 100,000 units of the base currency. Okay? You have to fund 100,000 units of the base currency. So you have to be funding, let's say, $100,000 to enter a lot size of 1. But if your broker gives you a leverage of 1 to 2, it means you will just have to handle 50% of the deposit, that's $50,000, and your broker will then fund the remaining $50,000. That's 1 to 2. So your broker is giving you half or 50% leverage. So when a broker gives you times 10, okay, that's 10 to 1. that's 10 to 1 leverage. It means you just have to fund 10% of the amount needed to fund that trade. And when your broker gives you 100 to 1, means times 100, it means you just have to fund 1% of the amount needed to enter that trade. And when your broker gives you 1000 to 1, it means you just have to fund 0.1% of the amount needed to be able to actually enter the trade. Okay. Now you might think that, wow, leverage is very good. It gives me the opportunity to earn a lot of money with just little deposit. It gives me the opportunity to enter big trades, make a lot of money. But like I said before, leverage is something you have to handle with caution, how to handle with care, because it can make you or break you. The same way leverage enables you make so much money, leverage can also enable you make so much loss. So let's assume your broker gives you a leverage of 10 to 1, okay? So it means you have to just fund 10% of the amount needed to enter that trade. And you now enter the trade and it starts going in your favor. It means you're making so much money. And then all of a sudden, the trade starts going against you. Now, when the trade starts going against you, all you have to do is to lose just 10% of that trade, okay, which is your initial amount. Remember, your broker is giving you the remaining. All you need to deposit is 10%. So when you lose 10% of that trade, okay, when you lose 10% of that trade, it means when you've exhausted your own money, your broker will just shut down your account and just remove their money. So it means they're not taking any risk on you. All the risk is on your head, and just because they give you leverage doesn't mean to actually use their money to fund your trade, even while you are losing beyond what you can actually afford. Okay, so that's why leverage is very dangerous. That's why using too much leverage is very dangerous. Same as the leverage for 10 to 1, 100 to 1 or 1000 to 1. So just like how leverage enables you to make a whole lot of money, same way it also magnifies your losses. Magnifies your losses if you don't use leverage correctly. That's why in Forex trading, we have what we call risk management. Okay, and we're going to be looking at risk management in further lessons, but just for you to know. Now that will be it for this lecture on leverage. I'm sure you can now understand the downsides and upsides of leverage and how good or bad leverage can be. Now in the next video, we'll be talking about other concepts like the take profit, the stop loss, and so on and so forth. Hope to see you in the next. So when we talk about the stop loss and take profit, what do we mean? Now, stop loss is designed to let your broker know how much you are willing to risk with your trade, and the take profit does the exact opposite. It's designed to tell your broker how much you are willing to make as profit with your trade. Okay, so all these are features in your trading platform, and whenever you are trying to enter an order, that's whenever you're trying to either buy or sell a currency pair, you are given the opportunity to insert your stop loss levels and your take profits levels, and you can actually modify them. Now, these are very important features. We're going to be using them very much in later times, in later lessons, and especially the stop loss in the lesson on risk management. Okay, we're going to be learning more about the stop loss. Now, the stop loss level, for example, allows you to ascertain the amount of risk you are willing to take for that trade, that the amount of exposure you are willing to have on your account. Now, when you have your stop loss level known, you will then be able to know what lot size you have to take to be able to risk the exact percentage you are willing to risk. So let's assume my strategy tells me to risk a percentage of 2% per trade. So I'm risking 2% of my total deposit per trade. Now with my stop loss level, I'll be able to understand how many, what lot size I'll have to use to be able to risk 2%. Okay, remember, we spoke about the pip value, we spoke about lots, we spoke about pips. Okay, and remember, the value of your pip is dependent on your lots, and the profit or loss you make is actually dependent on your lot and the pips you make. Okay, depending on your loss and the pips you make. So now if I'm going to be using my stop loss, I'll be defining the amount of pips I am willing to lose. So that will directly affect my lot sizing. That will directly affect my lot size. The same thing with my take profit. So my take profit is just a target for how much I am willing to make for that particular trade. Okay, so that's the idea for stop loss and take profit. So let me just use trading view again for example, and let me just create line. Sorry. So as you can see, this is our current price. Our current price is 1.20662. Okay. Now we have this horizontal line here, and we have this other horizontal line here. So now let's assume I'm selling this market, or let's say I am selling GBP USD right now. And if I enter a sell trade right now, my stop loss will have to be at this point. That means my stop loss will have to be above my entry price, and my take profit will have to be below my entry price, because I am trying to see that I think the market is going to keep selling, okay, for a sell. So my stop loss will have to be here so that I am stopped out if in case the market refuses to go in my direction and continues going up. This is very important. Okay, stop loss is very important if you must be a consistently profitable trader. Now the take profit level will actually be here, because we are telling the market that if it continues to go as I've predicted, that's if it continues to sell, I want to be taken out at this point in profit. Okay, so coming to our trading platform, let's assume we want to enter a trade. I'm going to go through the trading platforms with you. So this is just for you to see what I mean by the stop loss levels and the take profit levels. Okay, so let's assume I want to enter a trade. Let's assume I want to buy or sell. So let's assume I want to buy. I'll have to have my stop loss below and have my take profit above. Okay, so I will just have to copy the price level of my stop loss level. Remember, this is my stop loss level, and then place it here and then paste it here. Okay, remember it's 160.165. Now you can see 160.165. All I did was get the properties of the line and then copied the value and pasted it. And same thing for my take profit level. And when I do it like this and then I buy, okay, then I just buy. Okay, let me just buy. So as you can see, I bought, and now we have my stop loss here and my take profit here. So I'm just going to close this trade. So this is just for you to understand. Okay. So that's it for stop loss and take profit. So your broker has the responsibility to close your trade once your stop loss or take profit is hit. Okay, because your broker is responsible for the trading platform. So your broker connects you directly to the market. So your broker is responsible to open your trades and also to close your trades when your stop loss or take profit levels are hit. So that will be it for this lecture on stop loss and take profit. Hope to see you in the next video. Bye. In this video, we'll be learning about orders and types of orders in Forex trading. So what is an order? An order is basically an instruction sent to your broker using the provided trading platform to open a transaction or a trade. So when we want to enter a trade, when we want to buy or sell a currency pair, we have to send an order, which is an instruction to the broker to buy or sell our desired currency pair. Okay, so what are the types of order? There are basically two types of order. We have the market order and we have the pending order. So a market order is an order instantly executed at the price that your broker has provided. So for example, the bid price for Euro USD is currently at 1.2240 and the ask price is at 1.2242. So if you wanted to buy Euro USD, it will be instantly sold to you at 1.2242, which is the ask price. Okay, remember we said we buy at the ask price and then we sell at the bid price. So a market order will instantly execute a buy order for you, or rather a sell order for you at your ask price. Okay, so what is then a pending order? A pending order is an order executed at a later time, which is specified by the trader. So there are basically two types of pending orders. We have the limit orders and we have the stop orders. So the pending orders are like you telling your broker, when the price gets to this point, enter a sell trade for me, or when the price gets to this point, enter a buy trade for me. Okay, so that's basically what the pending order is. There are limit orders and there are stop orders. Now for limit orders, a limit order is an order placed to either buy below the market or sell above the market at a certain price. So you're either buying below the market, okay, or selling above the market price. So when the price is at a point, you place a limit order to buy below or sell above. Okay, let's come here and take for example. So if I'm to place a limit order here, if I'm to place a sell limit, I'll be telling the market to place a sell order for me here. I'll be telling the broker rather to place a sell order for me. Let's assume I want to have a sell limit at this point. Okay, so a sell limit has to be above the current price and a buy limit has to be below the current price. Okay, so I'll basically be telling the broker to enter a sell trade for me when the price reaches here, for example. Then I'll be telling the broker to enter a buy trade for me when the price reaches here. So this is a sell limit and this is a buy limit order. Okay, so that's it for buy and sell limit. So once the market reaches the limit price, the order is triggered and executed at the limit price. Okay, once the order reaches the limit price, the order is triggered and executed at the limit price. Now coming to stop orders, what do we mean by stop orders? What's a stop order? A stop entry order is an order placed to buy above the market or sell below the market at a certain price. So you place a buy stop order to buy at a price above the market price, and it is triggered when the market price touches or goes through the buy stop price. Now you place a sell stop order to sell when a specified price is reached. Once the market reaches the limit price, the order is triggered and executed at the limit price. So again, let's come to our trading platform, and then remember the last time we said we have the limit orders, and when we want to place a sell limit order, we have to place it above, and when we want to place a buy limit order, we have to place it below. Okay, so for stop orders now, when we want to place a buy stop order, we have to place it above our current price, and when we want to place a sell stop order, we have to place it below our current price. Okay, so remember, for sell limit it was above our current price, and for buy limit it was below our current price. Now for buy stop, it has to be above our current price, and for sell stop it has to be below our current price. They are basically the opposite of each other. And I know this could be very confusing in the beginning, that's differentiating between a buy stop and a sell stop, or a buy limit and sell limit. Okay, but do not worry, because these are concepts we're going to be using very much in our future lectures, and we're going to get very familiar with them. Okay, so I'm just going to show you an example of the buy stop and sell stop, and also buy limit and sell limit orders here. So as you can see, this is GBP USD we're looking at, and then now what you see as volume is actually the lot size. Volume stands for lot size. Okay, so stop loss, take profit. Now when you come to type, you see that here is market execution and you have the button to sell by market and buy by market. Okay, so when you come here, there'll be a drop down menu where you can choose pending orders. Now the pending orders, and you then see type. Now when you click on type, you see that we have the buy limit, sell limit, buy stop, and sell stop. Okay, so like I said, the buy limit has to be below the current price, and then the sell limit has to be above the current price. So as you can see, the current price is this is the current price, so it means if we're placing a buy limit, it has to be somewhere here. So I'm just going to come here, copy the value here, and then come to this buy limit and then paste it here. Now you can see if when I place the order, you can see that we now have a buy limit. Okay, so now we can see that buy limit, and when the price comes down here and hits our buy limit price, it's then going to create a buy order for us. So same for sell limit. Come to properties and copy, and then come to types of orders and then use the sell limit and just paste. When I place, we can see that we now have the sell limit here. So when the price comes here and hits our sell limit, our broker will trigger this trade for us, will enter this trade for us, and then the market, hoping that the market will sell downwards. Okay, so that's how we place a buy limit and sell limit order. So let me place a buy stop and sell stop order. So remember I said the buy stop has to be above the current price, and then the sell stop has to be below the current price. Okay, so for the buy stop, I'm just going to copy the value for this line and come to buy stop. Now you see buy stop, and I place it. You can see that a buy stop order has been placed here. So when the price reaches here, it's going to trigger a buy order for us. And finally, for the sell stop, we come and copy our value and come to sell stop and place. We'll then see that we have now placed a sell stop here. So when the price comes here and triggers here, we are going to enter a sell trade and hoping to take the ride downwards. Just going to delete all these trades right now. So that will be it for this lecture on orders and types of orders. Hope to see you in the next. Bye.